in. Before I begin, I wanna apologize for any background noise because it seems that today is a noisy day since it's a public holiday. So in today's video, I'm going to show you how to trade the three drives pattern. So this is going to be a part 2 of the first how to trade the three drives pattern video I made. I wanna quickly go over the rules for this pattern or setup. You wait for a fair value gap. No, you wait for price to create 3 consecutive highs. By consecutive highs, I mean you wait for price to take out liquidity 3 times without taking the opposite end of liquidity. So if price is creating lows, you wait for sell side to be collected 3 times, creating 3 lows before it takes out buy side. So I'm going to quickly show you what I mean. Second rule, you wait for a market structure shift and then you enter at the fair value gap and you aim for liquidity. So I'm gonna be looking at NASDAQ futures contract. So this is a continuation of the first video. The first video I was looking at the morning session of this day. So today I'm gonna be looking at the morning session of the previous day to that. So I was looking at the 21st of September there. For this video, I'm gonna be looking at the 20th. Again, I'm on the regular trading hours. So my candles open at 9:30. My new day begins at 9:30. So we see the market opening at 9:30, and then immediately we had this new day, opening gap. So let me just use a different color for this. We have this new day opening back, and you can see price trading back to it. But for the sake of simplicity, I'm gonna remove it. So you can see price opening at 9:30, immediately filling the gap, and then breaking higher. Price collects initially the buy side we had from the previous day using the gap, and then it obviously goes through this high and this high as well and creates a short-term high. Ne? Price then creates a swing low, a short-term low here, and then it takes out this high. So now we have one, and then the second high as well, consecutive high after this one. After that, price goes lower, creates another swing low here, and notice how price does not rate this low. So it creates another low above this low, and then it rates this second high once more. So now we have 1, 2, 3 highs. Buy side liquidity from the previous day collected. Buy side liquidity from the open collected. So we have 3 highs after buy side has been collected. Swing low here, swing low here. Market trades through the swing lows, creating a bearish market structure shift. In other words, price confirms that it's in a sell program. Hence, market structure shift. So price was delivering higher prices. Now it's going to deliver lower prices because we have a bearish market structure shift. So after a bearish market structure shift, we look for a fair value gap. Wait for 3 consecutive highs. We have the highs. Wait for a market structure shift. We have a market structure shift. Obviously, a market structure shift cannot be a market structure shift without the fair value gap. Then you enter at the fair value gap and you aim for liquidity. So which liquidity are you aiming for? We have relatively equal lows. So notice this low here and this low, they are relatively equal. So we call those relatively equal lows. That's sell side liquidity. So price we want to trade to that. So we are using this as a draw on liquidity. Hence, I'm using this emoji to emphasize that price will draw to that. So that's the liquidity we're aiming for. You enter at the fair value gap. We have a fair value gap there. So you can go for a short at the fair value gap. Stop loss above the candle that creates the fair value gap. Then obviously you're aiming for sell side liquidity. So that's the first entry you can take there. I'm just going to remove it for the sake of simplicity. So that's the first entry you can take there. What time is it? 10. So at 10 o'clock, the market trades into this fair value gap. That's a silver bullet. So the silver bullet fair value gap is not necessarily a fair value gap created in between 10 a.m. and 11 a.m. Price can trade to a previous fair value gap. Nevertheless, if you want to wait for the fair value gap created in between the 10 o'clock hour, as soon as price trades to this fair value gap, it breaks lower, creates this small pocket of imbalance here, this small pocket of imbalance. So that will be your silver bullet fair value gap for the day, the first one. So when price trades back to that, you can sell that. As soon as price trades to the fair value gap for the first time, you can sell that. Stop loss above the candle that created the fair value gap. You're still aiming for the same sell side liquidity. So that's a 15, 1 is to 15. 1 is to 15, then the market breaks lower. We have this consecutive, this 1, 2, 3 candles. That's one order block on probably the 3 minutes time frame. Nevertheless, we have this huge candle here. That's an order block. So the opening price of the order block is very sensitive. You can see price trading to it there. You're looking at this. You're looking at this open price. So the opening price of this order block is 153.92 and 50. The high on this candle should be 153.92 and 50. That is the same price. So that's a rebalance in price. We call that perfect price delivery, and you can sell that and put your stop loss above the order block, basically. Or if you wanna be greedy, if you wanna be not greedy, but if you wanna have a less small stop loss, you can put it at the opening price. At the closing price of the order block. So you can put your stop loss at the closing price of the order block. You don't expect price to trade to that. Take profit still the same. So you see price trading to the order block here. Initially we had a fair value gap. If you're not trading order blocks, you can trade a fair value gap. Where in the fair value gap? Well, as soon as it enters, you can sell that. As soon as it enters, you can sell that, or you can wait for the midpoint of the fair value gap. In other words, the consequent encouragement. You could also sell that. Then you see price trading to the order block, but the bodies are staying within this fair value gap. So that's a good note to take in price. Price trades lower. order block here once more, you can sell that. Now this time it did not trade to it perfectly, it just went a little bit above. We call that a mohawk. So each time it goes above just a little bit, that's a mohawk. Price is catering for spread. Nevertheless, you sell that stop loss above the order block, since the closing price is almost the same as the high of the order block. So you can sell that as well. Or you can sell the fair value gap. It's also fine. As soon as it trades back to it for the first time. So if you're trading the order block, stop loss above the order block, take profit is still the same. Then we see price trading lower and then taking out your target. So price take out your target at 11.23. You can exit and be done for the day. So that's how you can trade the three drives pattern. So the inception of the move started after this signature and price. Thank you for watching. If you find this insightful, please give it a thumbs up.